Welcome to the Real Estate Investing School podcast. I'm your host, Joe Jensen. We've got a very special guest today. He is Dave Meyer, the Data Deli man. He's the VP of Data and Analytics at a little place you might have heard of called Bigger Pockets. So we're stoked to have him on the show today. Welcome, Dave.
Joe, thank you so much for having me. It's a pleasure to be here.
Yeah, man. So this is a treat. I'm excited to talk to you about some of the different pieces of what you do. You, to me, are like the truth and the brains behind real estate. I mean, there's so much.
Wow. Thank you.
There's so much noise out there about like, oh, this is how you invest, and look at me, I have a Lamborghini, and whatever. Like, people are like, trying to be all cool and do all this stuff. And yours is just different than most of the content out there, because you're like, look, these are the facts behind it. This is the real info. And then the investor can interpret that as they need for their personal strategy. But maybe you can tell us a little bit about your story, or I'm excited to hear about how you got started in real estate, how you dove deep into the analytics side, but also your personal investing side. I think that's something a lot of people might not realize is you don't just like look at this stuff from the sidelines. You're actually playing the game as well.
Well, thanks, Joe. That's a very nice compliment. I do try and just present unbiased facts about real estate and help people make their own decisions. So that's a nice compliment. Thank you. I have been investing for about 12 or so years. I got started about a year out of college. I graduated from undergrad in 2009, and it was just a terrible job market. And I moved to Denver and was waiting tables. And actually, I liked the job. It paid pretty well, but I had a lot of time on my hands. And I went skiing with a buddy of mine, and he was telling me how he and his girlfriend just bought this rental property, and they were making an absolute killing on it. And I decided to just spend more of that free time that I had learning about real estate. I didn't even know about Bigger Pockets at the time, but I learned what I could and was already like pretty decent at Excel. I could build a bit of a financial model and was able to find 3 partners to go in on my first deal with me. I didn't have the money for even a quarter of the down payment. I was fortunate to have someone I could borrow that from, a family member I could borrow that from. So that was helpful. Not everyone has that, so I'm lucky for that. But basically I did that. And that deal turned out great. Buying in Denver in 2010, did pretty well. Yeah, exactly. Yeah. But over the course of the next couple of years, I did 1 or 2 more deals, a couple small multifamilies in Denver. But at the same time, I'd always been working in like tech and analytics, and went and got a master's degree in data analysis. And after that, I was like, man, I really love data and I love real estate. I want to do them like both together. I don't want them to be separate things. And so I Googled like real estate technology company, and I came across Bigger Pockets. I was investing. I'd never heard of it, and it was like a mile from my house. No, and I was like, damn, I got to get a job here. And so I waited and I sat on it because they didn't have any jobs. It was a really small company at the time. I waited like 6 or 9 months, and they finally had a job that was aligned with my skills. Applied and got it, and that was about it. So I've been working in data. I do invest more now, and get to help people invest in real estate too. So it's really been a sort of a dream job.
Yeah, that's super cool. Like, so I want to go back to your initial investment. It's funny because one, you're like, oh, it was good timing, but who knew? I mean, some people kind of knew, but a lot of people, no one really knew what was going to happen. We didn't know we were going to have 10 years of just 12 years of just skyrocketing, like, so who knows what the next 10 years look like. There might be looking back and go, oh, you bought in 2022, good timing, you know what I mean? Like, who knows?
Yeah.
Right. But
it's so true. Yeah. I just like at that time, I didn't know really honestly the first thing about the housing market. Yeah. And I just ran the numbers at the time, and it cash flowed. And I was like, great, I need cash. This is great. And was able to make it happen, but I wasn't thinking about the future. And the market didn't bottom for about another year and a half after. So,
Mm-hmm.
yeah, prices went down, but then they went back up in a significant way. And yeah, we could talk about it later, but agree that trying to time the market is very, very
Yeah,
tricky.
no, I love two things. That like, as if it cash flows, it works. You know what I mean? If it's working, it'll work. There might be a lot of other things you could do a better thing beyond just the cash flow if you understand more. But if you understand that enough, you're probably going to be safe. But the other thing is funny. You're like, I didn't have enough money for a quarter of it, so I partnered with three people for the other three quarters, borrowed money for my quarter. So if you're like, oh, I can't get into it, it's like, ah, look what Dave did. You know what I mean?
Exactly. And yeah, I mean, I am lucky to have someone I could borrow that quarter of a down payment from. And just so people know, because people always ask me how I structured it, I managed the property. And so I got paid as a property manager. And then I used the money that I got paid as the property manager to pay off the loan that I got. And it
That's
just
cool.
worked out really well. And as I'm sure you know, Joe, like it's all about with your first deal, it's really just about
Mm-hmm.
learning. And it gave me a lot of experience to learn. I mean, managing a property, you just learn so much about investing. You learn a lot about, people think it's just about property management. You learn so much about deal analysis, what to look for in properties, what you want to avoid, that kind of stuff. So, yeah, it is cliche in our industry to say it, but just getting a first deal is so important. I'm not saying just buy anything, especially in this kind of market. You don't want to just buy anything, but if you find something that cash flows in a good market and you can get in, it's the most important thing.
Yeah, for sure. I think that's money. So you did that. This was back 2010. You started working with Bigger Pockets, doing the analytics side. Um, how how have you seen your perspective on how you invest grow and change over the past decade? You know, like maybe kind of what you were beginning to focus on and what you kind of look towards and lean towards now is more of a priority.
Totally. Yeah. So when I first started, I was really very focused on cash flow. And I think that's a good place to start for anyone listening to this because you do, especially me, I was waiting tables. I didn't have a ton of money and I wanted more cash. And it is a really good defensive, low risk way to start investing is prioritizing cash flow. So always recommend that for people who are starting. But over time, I've dedicated myself to learning a lot about the housing markets. And so now I do invest mostly passively. I live in Amsterdam in the Netherlands. So
That's what's up.
it's hard for me to go. It's hard for me to go buy deals right now. And so I've sort of forced to invest more passively now. But it really suits my strength, which is data analysis. And it helps me like pick markets that I think are going to be good long term, even though I'm not, you know, controlling all of the operations. Not everyone needs to do that, but that sort of suits my strengths and my personal interests. So I've been investing more in that. I do have one short-term rental, but generally speaking, I just think multifamily, even small multifamily and small multifamily is a great investment and will continue to be over the next 10 to 15 years. Just looking at population and demographic trends,
Mm.
it just seems like there's going to be a continued imbalance and there's going to be more demand than supply in those markets. Not in every single city and town, but generally speaking, that tends to be true. And so I think it's going to continue to be a good investment.
Well, if you say it, then it's probably true, right? Um,
Don't take everything I say for fact. I mean, I think it's true, but everyone should do their own research as much as they can.
and there's always these unseen variables, right? It's like, man, you could think you know everything, and then you get hit with a pandemic, and appreciation doubles in 2 years what should have taken eight. You're like, where did that come from? You know what I mean? Who could have
Totally.
predicted a year before? You know, but so
Absolutely. Yeah. I go
no,
ahead.
just gonna ask you about. You said you invest passively. Can you describe how what that looks like for you, and what do you mean by that? Because you're obviously investing remotely, and then you say passively. You know, is that like syndications, or you just have hired acquisition managers and property managers? What does it mean to you to invest passively?
Yeah, right now, since I've moved to Europe, I've exclusively invested in syndications, large multifamily syndications. I am now looking at one like development kind of play. but all mostly residential projects. And I do that just out of necessity, but also I do think there's sort of this hierarchy of investing. And one end, at the low end, you probably have like house hacking, which I did. It's amazing. I love house hacking. It's like probably the greatest real estate strategy out
Sure.
there. Um, but it's, it requires some personal sacrifice. You're living with your tenants, and it's, there are pros and cons. Fantastic way to get started. Then, you sort of move up to like small multifamilies. I don't flip houses. It's, I have a full-time job. But I think ultimately, like, sort of the pinnacle of where you want to get to is this like truly passive investing,
Right.
which is syndications or lending. And that's fortunately where I am right now, where I don't have to go find deals, and I don't need to, manage them. If I move back to the US, I probably would continue buying some things actively. But for right now, given my lifestyle, this is what works for me.
Yeah. No, and that's one thing I love about real estate that I think sometimes people don't quite understand is it's so customizable. You know what I mean? Like so customizable. Like I said, from the house hack to the cash flow to the hands-on rehabbing guide to the totally hands-off, syndication, whatever you want to do with your situation, it's so customizable and you can pivot and change as your life changes, which is exactly what you're doing. And that's kind of how when I set up my game plan, when I was like, I'm going to go all in on real estate, it's like, okay, check one, I got to build my cash flow to this amount. So then I have the time, the freedom to do this. And then I can start doing bigger projects with exits and actual payouts. And then eventually just pump money into doing nothing like on syndications. Like there's a whole, like say, hierarchy of a way to do it. And it's very different if you have an active, high paying income. You can have money to put into things. If you don't have that, then obviously you're
That's right.
making your money in the real estate. So there's so many different ways. But
Yeah,
nowadays, even in
I
Amsterdam,
totally.
you could remotely do a lot of stuff. Though it's not like you're stuck with syndications doing remotely. You can do anything remotely nowadays. It feels like.
Oh, totally. Yeah, I would buy if I probably will start looking in the next couple of months for more individual deals, but really resonate with what you were saying, Joe, in that real estate is really
Mm.
customizable. And it's funny, I'm writing a book sort of about this, right? Currently writing it. It will probably come out next
Oh,
year.
sweet.
But it's just all about how there's just different things for different people, and a lot in social media. Um, Everyone sort of has their niche, and I get that. Like if you're a wholesaler, you probably want to teach people how to wholesale, and if you're a flipper, you probably want to teach people how to flip, and those people probably have good intentions. But I do think it's up to every investor to determine for themselves what it is that they want to get out of their investing career. And then once you know that, I mean, then it's easy, right? Like there's, like you said, like there's so many different strategies, but like if you know the lifestyle you want to live, the type of career that you want, then there's a real estate strategy for pretty much everyone. And then, as you learn about it, you can really sort of match the strategies to the lifestyle that you want to live.
100%. And that's what's really cool about what you do specifically, because the content you create, pardon me, the content you create is different. Because, like I said, if you follow a wholesaler, a flipper, a cash flow guy, or whatever, they're pitching what they know, which is what they should do because that's what they know. But when people follow you on the Data Deli on Instagram, they get information that applies to all of those things or none of them, depending. I'll watch one of your reels and I'll be like, oh, that's so good to know, and I'm thinking of ways that could impact my investing strategy. And then other stuff I'm like, oh, that's really interesting. Cool, though, makes no effing difference to my strategy. So I don't have
Yeah.
to worry about that kind of weird, scary, unknown thing he's talking about. Like, I don't care. It makes no difference to me. And anyway, that's what's cool is people can take that content and just decide how it applies to them.
Yeah, thank you for saying that. And yeah, I totally agree. I'm always just trying to learn and then share information with people. I know that most people don't want to spend like hours looking through data sets and spreadsheets, but for some reason, some weird reason, I like doing that. And so I'm happy to just share what I learn with people. And, sometimes I go into it trying to find something out for my strategy. I'm like, oh, that doesn't even apply. But I'll tell people about it. So yeah, I just think you need to understand, you asked how my investing has changed. And I think one of the main things I've recognized is how important macroeconomics are to the real estate industry. And I honestly, when I first started, did not know really what the Federal Reserve did or what housing supply was, or how to measure the quality of a housing market. And I just hope people learn it, because you can get by first few deals without it. But if you want to scale a portfolio, you really need to sort of understand what the big trends are in the industry to be able to make effective decisions.
Can we expand upon that and talk about how do we digest information you're giving on macroeconomics to apply it? Because I'm saying, oh, you can apply it to your own strategy, but I think for a lot of especially newer people, they might be looking at it and go like, what does that mean to me? So maybe you can break down maybe a few examples of some macroeconomic things that are occurring and what that would mean to the common investor.
Sure. Yeah. That's a great question. Well, the most relevant one I'm sure you saw yesterday is we're recording this in late September, but the Federal Reserve raised interest rates again 75 basis points, and that's like a good headline, right? Like everyone knows, like, oh, that's crazy, rates are going up. But I think most people don't understand that what they're talking about there is not mortgage rates, for example.
Right.
They're setting the federal funds rate, which then sure impacts bond yields, which impacts mortgage rates. But it's this whole complex, sophisticated financial system. And just reading that headline and saying like rates are going up, mortgage rates are going to go up, is not necessarily true. Like mortgage rates probably will go up a little bit. I'm just saying in general, if you look at the way most analysts are thinking mortgage rates are going to be, they're predicting 5.5%, 6% in 2023, which is lower than they are now.
Right.
And so like if you were not learning about this, you could make a false assumption about the way mortgage rates are going because you don't fully understand it. And that's okay. Like it is sophisticated, it's complicated, but I think I just think you sort of have to learn about that. One other thing that I love talking about right now is like my topic du jour is inventory, because I think that's like the best lead indicator. And in data terms, that's just like a lead indicator is a data set that predicts another one.
Mm-hmm.
And so a lead indicator for housing prices is inventory. And people are saying, oh, the housing market's crashing or it's doing great. And people are arguing about that. But there's a lot of nuance to that debate. And if you look at a market like Boston, inventory is very low, which indicates prices are probably very stable and might keep growing over the next couple of years. If you look at Boise or Austin, inventory is above pre-pandemic levels. And so the market is probably going to decline in those markets. And that's okay. Either is fine. It's just you need to know that so you can make informed decisions, right? Like in Boston, if you're or Philadelphia, or these markets that look stable, you probably aren't going to be able to negotiate, and you could find something that's cash flowing and assume market appreciation. In Austin or Boise, it's going down. Does that mean you need to avoid it? No, it just means that there's going to be opportunities to negotiate, right? Like that means that sellers are going to panic. Most likely, there's going to be more under market deals happening, and that you just have to adjust your strategy accordingly. I personally believe like you can invest in pretty much any kind of market. You just need to know how to adjust your strategy. Like you shouldn't
Mm-hmm.
be flipping houses as a newbie in Austin right now. Like that's a terrible idea. Should you be negotiating for small multifamilies that are under like 5% under market value? Yeah, that's a great deal right now. So like I just think that's what people need to understand. And that's what with my social media and podcast tried to help people understand. But there's plenty of other resources where you can learn that stuff too.
Yeah, I think that's great. And that's what I was thinking as you were describing. I was just like, if you're just buying cash flow, then both markets work as long as you can find the deal. It might be easier to find the deal. That's what I say a lot of times. They're like, oh, is this a good time to buy? I'm like, it's always a good time to buy if you find the right deal. It just might be a harder time to find the deal or an easier time to find the deal. And like you said, if you're a house flipper or trying to do a hardcore burr, that's where those, if a market's softening and going to go down in value, you got to be a lot more careful. But if you're just buying cash flow and not doing anything creative, that's why it's so safe. Is you just can't really make that many mistakes as long as the asset's not like a complete money hole, you know.
Totally. Yeah, absolutely. I think people are saying, now's a bad time. And it is a challenging time. I don't think it's necessarily a bad time. It is a challenging time. But so have the last 2 years. It was deals were hard to come by because inventory was so low over the last 2 years. Yeah, in retrospect, like 2012, 2013, that was a good time to buy. But you never know when that's going to happen. And I just think realistically, you have to just think about this whole industry as long term. If you're looking to make, ton of profit in a year, 2 years, you can do it, but it's risky. There's risk in that. If you're buying for 5 to 10 years, there is
Mm-hmm.
relatively low risk in almost any strategy, any buy and hold strategy, I should say.
Yeah, 100%. And it's funny you mentioned, back, 2012 been a good time to buy, but it had its challenges too. It was hard to get a loan because the banks were all like, look what just happened. We gave out way too easy of loans. So they were tightening their belts so hard that, people that were trying to do it, especially newbies, they didn't, it was a hard time to get a loan for a lot of people. The banks weren't lending like they were at other times. So there's always pros and cons of every timing of the market. Um,
Yeah,
but
absolutely.
that's sweet, man. Well, let's kind of shift gears a little bit. Maybe you can tell us kind of some of your guiding principles or habits that you've applied to either the real estate side or maybe how you digest the data and your business side. Obviously you kind of are in this in a little more ways than most investors. But what are some of the kind of guiding principles or habits that have led you?
Yeah, I mean, I think the number one thing is just like trying not to overthink things. People like, are constantly, ask me for advice and they come up with these 90 variables of like, this is going to happen and this could happen. The reality is no one really knows. It's like, does it work right now? And like, are you investing in a market that makes sense long term? Like, it's probably a good deal. So I think like that is a tendency, is that a lot of people really really try to overthink. I personally am like quite a conservative investor. I don't flip houses. I don't try and wholesale. I buy in markets that are growing economically and population wise. I try to buy in good areas where people want to live. I'm not like trying to like reinvent the investing strategies myself personally. I try and stick to the um to the tried and true methodologies that have been proven by literally millions of people. Like, to me, as like an analyst, you're like, well, this is a near certainty to work, so I will just follow what other people are doing. And so I think those are really sort of like, in it from a real estate perspective, the principles that I've excuse me, follow. And then I think just like in life and in real estate, it's so much of it is just about focus and deciding what you want to do with your life, and then wanting what you want to do with your portfolio. And once you get really clear on what you want to do, and there can't be that many things, you have to pick a few things that you want to focus your life on. Once you do that, it's very motivating, and I think you find success in those things if you could say like, here are the 4 or 5 things I care about. Here are the 4 or 5 things that I am going to work on and pursue every single day, and that's worked well for me.
I love that. Something my first real estate mentor, which was my dad, actually would always say, he said, "You can do anything you want. You just can't do everything, especially at the same time." Right?
Exactly.
And I love that your idea of just keeping it focused on these few things, because if you're trying to do all of it at the same time, it's a hard thing to do, and it's not realistic.
Absolutely. Yeah. That goes with life and real estate too. Like, sometimes I have friends who wholesale and they're doing these crazy assignment fees over the last 2 years. And you're like, man, I want to do that. But you have to sort of like humble yourself and be like, I can't learn everything. I'm not that person. I'm the person who invests passively and traditionally. And like, I've chosen that path. And like, you get a little bit of FOMO for sure. It's better in the long run to just stick with. I just think it's about being intentional, right? Like this is the path I'm on. And you walk in and try and not get distracted by all these other opportunities, because there's always going to be opportunity, but you have to just like pick the ones that are meaningful to you and that you think are like best aligned with the life that you want for yourself.
For sure, man. That's something I always talk to my students about. I'm like, you are going to have to pass over a ton of really amazing good deals for other people because they're not aligned with your strategy and your position and your situation. So it's an amazing deal for someone else. And you just have to know that's just how it's going to be. Because as soon as you niche down at all, you're cutting out amazing opportunities, which can be really, like, that FOMO. You want to be able to do everything, but you got to just kind of focus, and then you can pivot. For me, it's like I have like a 4-step page. It's like, this will be my focus, then this, then this. But first, I've got to just get in super narrow focused on just the first step. You know what I mean?
That's right. Yeah. You're going to have to just like put blinders on.
Well, you're kind of like me. I think we're both pretty conservative of how we invest. We don't do anything too crazy. I'm not as much of a I'm not as knowledgeable of the analytics and the data side. I like that stuff. I don't know much about it as much as you do. But being risk adverse, have you had any failures when it comes to real estate investing? Not your dating life or marriage, just let's just talk about real estate investing.
Well, yeah, that would be hours of content. But no,
those that subscribe.
yeah, yeah. So no, the short answer is no. Like I haven't taken a bath on any deals, but the flip side is I'd say like my biggest failure is not investing as much as I should have early in my career.
Yeah.
So I think like, there's flips, there's pros and cons, and like the pro is that I haven't lost money, but the con is that in retrospect, I probably could have made a lot more money, and built a bigger portfolio. And I'm okay with that. Like, like we were just saying, it's like, in retrospect, sure. But like I made a decision because I like my career. I like working at Bigger Pockets. And so I made a decision that like I'm going to invest as it makes sense for me, because I'm going to keep pursuing my full-time job because I really like it.
Yeah.
And so like, yeah, in retrospect, sure, could have done great. But like, and like even working at Bigger Pockets, I could have done more deals than I did, and I probably should have. So I think that's the biggest failure, is not, doing more. And I think I don't know how you feel, but I think like a lot of people who are relatively risk averse, who get or who are investing in real estate start that way until at least you have like enough cushion where you're like, okay, if this one doesn't go well, at least I got like some other stuff going on and I'm not going to be like in a bad spot.
100%. Yeah, it's funny when I came up with the question of asking about people's like biggest failures or favorite failures with this podcast. I thought that would be an interesting question, but by and large, it people have not lost money in real estate. Like every time I ask somebody new, they're like, "Oh no, I've never lost. I could have gained more. I could have won bigger, but it's always a win." Like so the only times it's just been like a couple little weird situations or maybe like a flip didn't work out, but it blows me away how many guests had your same response, Dave, where it's like, really, I haven't lost, I haven't been burned, which is not, you can't say that with most investment strategies of other vehicles. Crypto, you're not going to meet a single soul in crypto that's like, oh, I haven't
Yeah,
had a bath once in a while. You know what I mean?
totally.
It's interesting.
But we have been in a bear market for a bull market, excuse me, for 12 years. So I think that's part of it. So keep asking that question. I bet in 2 or 3 years you'll have a couple more failures.
Yeah.
I don't think the market's going to crash for that. I think it will correct, but I think there will be people who unfortunately lose their shirt on some deals over the next year or two.
Yeah, and especially like say when you dive the difference between the value add people, whether it's a burr or a flip or a whatever, versus the cash flow long hold people. You're putting yourself in a lot more position of vulnerability when you're banking on a sale or a refinance, as opposed to, oh yeah, we had more repairs than we thought. We'll make it up in the long end. You know.
Yep,
But
that's right.
that's awesome, man. I don't know if you have any other deals we could dive into besides the first one. If there's any maybe unique ones or maybe favorite ones that kind of come to your mind of any deals you've done? I know you don't do a lot of maybe unique stuff. You just follow the data. I don't know. You tell me.
Yeah, I think my favorite one is a couple years ago. I sold a property and was 1031ing. And if, for those of you who don't know, yeah, the 1031 has a very short timeline to find a replacement property. It's like 45 days. And I had a deal lined up in Denver, and it fell through like with 3 days to
Mm.
go, and I didn't have a backup. And so I called my real estate agent, who's a good friend of mine, and I was like, I've been wanting to invest in this ski town for years. I've always thought it was a good thing. Like, we're going to make it happen. He called, and we literally went and saw every single property for sale in the county. There's not a lot of people who live there,
Yeah.
but we went for every single one,
All
and we
set.
just like made offers. Yeah. And I got this deal, and it was my first short-term rental. I had no idea what I was doing. But I bought this place. I did sort of a BRRRR strategy where I added a couple bedrooms, made it into sort of a party house. And it's incredible. I love it. And now I get to go ski there because I'm a big skier when I'm back in town, or when I was living in Colorado. That's, I think I love that one because, to our point earlier, it's like, I think real estate investing can support whatever lifestyle you want. And for me, I was like, okay, I'm going to do this deal. I don't know if it's going to be a home run, but at the very least, I just want to go skiing.
Yeah.
Like that's like valuable to me. Like, people, like, there's nothing wrong with that. I just want to ski. And so, like, I did it, and I can ski. I go, a couple days a year, and it's actually turned out to be a fantastic investment. It's really been a home run, but I love that because, to me, like, when I first started investing, I was like, one day I'm going to be rich enough to buy a ski house. And then I was like, wait, I can just invest in a ski house and I can ski and it will still make me money. Like, I don't need to use all my money for that. So I just think it's like a cool story, or example of how real estate can, fit the lifestyle that you want, and that you can think creatively about it. You don't like have to listen to what everyone says you should be doing. You can come up with your own rules.
I love that one. What's interesting about that exact scenario is you were kind of backed against the wall to do something you weren't as familiar with. You know what I mean? It wasn't the game plan. It wasn't like, okay, I'm going to go get this Airbnb, and then you have all this time to run the data and overthink it. It was like, hey, you got 3 days to pivot, change your whole direction. And so you kind of went with your gut, it sounded like, with your heart of like, oh, well, this is something I've always wanted to do. Let's just do that if I have to do something within the next 3 days. Like, I don't have time to delve in and do what I typically do.
Right. Yeah. Yeah. It was lucky because, like, I kind of knew, like, I'd been going up there and just like driving around like for years, and just like, one day I'm gonna get a house up here, and I was just like, screw it, going for it. Yeah, it was fun.
Yeah, it's amazing how many times we have things like that are on our list, and we might even be like doing the studies, we're kind of prepared for it, but just for whatever reason we haven't pulled the trigger. And then when there's a moment of like maybe failure or risk, or it's like our backs against the wall, it's like, okay, I'm gonna finally pull the trigger on that thing that I wanted to for so long. It's like, maybe we should have just done that earlier. So that's cool. I like that example a lot. So tell us about the real estate market in Amsterdam. What are you buying out there?
Honestly, nothing. I don't know. I'm a renter. I am back to renting. I should have bought, I moved here right before the pandemic. So just like every market in the world just went absolutely nuts over the last couple of years. But, when we moved here, we didn't know how long we were going to stay. We still don't. So we just kind of wanted to rent, and we got like a furnished apartment. So it just made it easier, not have to rebuy everything. But there are a lot of the same challenges here that exist in the US. There's a housing shortage, so rents have gone up a lot. Housing prices are really going up. There's a lack of affordable housing. And yeah, it's just kind of been, you see similar things here and in a lot of markets around the world, frankly. You see similar dynamics going on right now.
Let's talk about international investing a little bit, because I know one huge key thing for me with real estate investing is leverage, right? Being able to use the bank's money for 80, 90, 95% of the purchase. Like, that's a pretty cool thing to be able to do. Now, when you get out of the US, the lending policies and options aren't all the same in different countries. I mean, are there other places outside the U.S. where you can just go get a nice 30-year lock, low interest? How does the leverage work in Amsterdam or any other markets like that? If you're familiar with the international investing.
I'm not super familiar. I know here for first time for like home buyers, it's actually pretty generous. Like you don't pay much above the prime rate. So like I know friends like during the pandemic were buying homes here and paying under 2% mortgages. Those are they're adjustable rate after like 7 or 10 years, I think. But I think for like the major banks here, at least in the Netherlands, don't really lend to investors in the same way. I think it's mostly private lending. So I think it's just not as available, generally speaking. But I can't speak to the rest of the world. I only know and even about here in the Netherlands, I only know a little bit.
Does it matter if you are like a U.S. citizen? Can you still get that kind of lending out there, or do you have to be like Amsterdam citizen?
You can. So you can borrow if you're a resident here, which I am. I'm a legal resident and have a visa, so I can do that. But uh, it's hard as an investor. Like they discourage investing, real estate investing here, with taxes and tax policy. So I've never really learned that much about it. I know like people invest in Portugal. I just know that that's a popular thing. I don't know why. I've heard Belgium is popular too, but I haven't really looked into it.
Sure.
I know the U.S. like part of my job at Bigger Pockets is to understand the U.S. housing market. So like, why am I going to learn? I'm not going to spend my time learning about Belgium. I know enough about the U.S. Housing market to make informed investing decisions.
You have enough numbers to crunch with the entire United States of America. That's plenty, right?
Yeah, that's right.
Well, awesome. Maybe give us some of your predictions. We can look back at a few years from now and laugh or praise
and laugh at me. Yeah.
Wise Dave.
Oh God, man.
But
yeah.
What do you kind of see happening in the next, let's say 3 months, 6 months, and then maybe like 5 years?
Okay, so I'm just like starting to come up with like predictive thoughts for next year. So you'll get a sneak preview, I guess. In the next 3 months, the Fed basically told us yesterday that they're going to raise rates through the end of the year, and it's going to end up with a federal funds rate at like 4 to 4.5%, which a mortgage rate probably going to stay in the mid to low sixes. To me, that is too much to sustain housing prices in the majority of housing markets. For a while, I was thinking that the Fed would like raise rates, things would go fine and then they would bring it back down. But with inflation remaining high, I think they're going to keep rates high for probably at least a year. That's a lot of sustained downward pressure on the market. So I do think we're going to see the national housing market probably in 3 months get, close to zero, year over year appreciation rates. I don't know if it's going to go below or above. If you ask me about 6 months, I think it probably will hover still around zero, plus or minus 3%, I would say, like on the national level. And then next summer, I do think it will probably go down a little bit more because that's when things really, in Q2 of 2022, things really skyrocketed. And I think when you compare 2023 to 2022, it's not going to look favorable for the housing market. That said, that's not every market. We talked earlier about, Boston, Philadelphia, a lot of places in Florida, North Carolina, the Southeast, the Midwest. They're doing fine right now.
Sure.
Will it hold up? I don't know. But I do feel pretty confident that like markets like Boise, Reno, Las Vegas, LA, Seattle, Austin, Denver, where I invest, those markets are going to go down. And I don't think that they are going to crash. I personally define a crash as like 20% or more. I don't think that's very likely, and I can tell you why. But I think realistically, somewhere, the worst case scenario, never say this, but like I think the most probable areas like the national housing market maybe goes down 3 to 8% or something like that in the next couple of years. But I think it will bounce right back up once rates go down. And I think that will happen in 2024 and things will start growing again on the long term. There's just a national housing shortage. And when there's a shortage and constraint on supply and it's difficult to build still, so it's not like we're going to all of a sudden get a glut of supply, that bodes well to the long-term prices. So I'd still invest because I'm not investing for 3 months from now. I'm not investing for 6 months from now. I'm investing for 10, 20 years from now. And so I think those still look good. I think just more predictions. I think a couple short-term rental markets are going to get hammered. Even the ones where I invest, the one I was just talking about, I think the prices are going to come down. We saw extraordinary demand for second homes in the pandemic, not even from investors, just from people. Extraordinary demand. It almost doubled. And now it's come back down to lower than pre-pandemic level. So that's fallen off. At the same time, we might go into a recession and demand from guests for short-term rentals is probably going to decline a little bit if people are struggling. And so you have this combination where people paid a lot of money in markets where a lot of them are first-time investors too, and they're going to have a drop-off in demand. And I think there could be forced selling. Like, I don't think there's going to be a foreclosure crisis, but I do think like some pockets of these like high-priced vacation rental areas could have some foreclosures. And so, I never root for people to lose money, but if that does happen, there could be buying opportunities in those markets for experienced investors. So yeah, those are some of the things I've been thinking about. But I think the major like X factor right now is new listings. So there's a lot of different ways to measure the housing market. Inventory is like how much stuff is actively on the market, but that's a combination of like supply and demand. New listings is just supply, right? Like that's how many new people decide to put their house on the market. And it's tanking right now. Like it's down almost 20% year over year. And that's significant. People don't want to sell their houses right now. And I think that's going to dictate a lot about what happens over the next couple months. We don't know just yet what's going to happen, but that's like the main thing. If I were you, I would be watching because I think it's super, super interesting.
Yeah, man, it'll be cool to see how it all turns out. I think those are some really good predictions. Makes me feel kind of good because that's kind of what I've been saying. I think we're going to see a plateau for a while, so validate some of my assumptions as well, which is always good to hear.
Nice.
Like,
yeah. I mean, No, I don't like. I think there's just at this point there's like almost no case to be made that prices are really going to go up. In a few markets they will, but like on a national level, there's like almost no case for that. I don't think it's going to be like a bloodbath, but I think people should underwrite deals without appreciation for a year or two. Even if it does, just to be safe, just assume that your property value is not going to go up for 2, maybe even 3 years. If it still pencils, go for it. But like, I would be pretty cautious about that.
I think that's really good advice. Let's dig into this, and then we'll kind of go into some of our end-out questions that we ask. But I want to talk about underwriting for a minute. Coming from the data guy, because that's what underwriting is everything just predictions based on numbers, right? So when it comes to your underwriting, how does Dave Meyer analyze a deal, run it through what calculator or spreadsheets, or do you have like your own special deal analyzer that you've designed? Do you just use Bigger Pockets tool? Like, how do you run the underwriting on a deal initially?
Yeah, it's a great question. Very conservatively is the short answer. I just think like I am always want to be pessimistic. I for like single family deals or small multifamily deals, I do use the Bigger Pockets calculator. If I'm going to do some sort of like more complicated financing option, I'll make my own spreadsheet. But if it was just like me buying with a traditional loan, I use those things. We at Bigger Pockets have a rent estimator tool, and I use that. And I honestly just like to, with appreciation, assume that most homes, unless you're going to rehab them, will keep track inflation. That is traditionally, before the Great Recession, like how things worked. Since the Great Recession until now, we've had this like very accommodative interest rate environment that I don't think is coming back. And so I think the safest way to proceed is to assume that we get back to some historical growth rates, like starting in like 2024. And so I'd say like 2 to 3% interest rate growth. Rent, I do think, is going to go up faster than inflation over the next couple of years. So depending on the market, you could assume 2 to 3%, but some might see 4 or 5%
Just because they need to
growth over
catch
the
up
next
with
couple of years.
the value of the homes, basically, or what?
Yeah, and there's just certain markets where like people are moving and there's just not enough
Yeah.
houses. Like you look at places like Austin or places in North Carolina, like they're not ready for the amount of people that are moving there, and that's going to shoot prices up. Whereas like places like I don't know, New York, well, prices have gone back up there, but places that are seeing losses, Chicago, for example, people are moving out of Chicago. They're probably going to be pretty flat. And so I base a lot of my underwriting assumptions on population and economic growth because that's really what fuels these things is like, are people moving there? Then prices are going to go up. But you also have to assume that your expenses are going to go up accordingly. Is there good job growth? Then prices are going to go up. But you have to assume that your expenses are going to go up. So to me, I only right now really invest in places where population is growing. Some people take a totally different strategy, but for me, that's like the safe way to invest is like, that demand is going to keep going up. And in this country for the last 15 years, supply has not been able to keep up with demand in popular markets. And so I'm betting on that continuing. When I look at like syndications, it's a little bit more complicated because there's just like a lot more factors into what to consider. Vacancy rates are a lot more considerable. If you're buying something or investing in something that's 300 units, you have to, they're starting with 70% vacancy. Trying to figure out how quickly they can improve that is a lot about the team's historical performance. You're looking at comps in those areas. So that's a little bit more sophisticated, but I honestly look at averages. I Google the averages for vacancies. When I invest in Denver, I use my own historical experience, and I've never had more than 1 month of vacancy. And so I use 1 month. That's relatively aggressive. So I mean, I don't think I do anything crazy for small deals. I think it's relatively obvious, I guess, is that like just use historical averages and don't presume that you're going to do better than that because you're not. And if you do, it's gravy.
Yeah,
Like it's
great.
great. Like then you're happy. But yeah, I just think that that's the safest way to underwrite like small multifamilies and single family deals. With short-term rentals, it's a little bit different. With
Sure.
multifamily, it's a little bit more complicated. But with the small deals, it's honestly I don't go crazy. I like I was saying, I just try not to overthink it. It's like place growing. Is it a good property? Does it cash flow? Cool.
I love it. Let's dig into a couple more metrics. So when let's say it is the right area, it is have job growth, population growth, decent area, good vacancy. What further metrics do you look at? Like do you look at the cash on cash return? Do you look at a cash flow margin? Do you have like a percentage? Like I want to have a certain cash flow margin. Or what are some like the number metrics that you look at when you're underwriting a basic single family home?
Yeah. So for a basic single family home, if it's relatively turnkey, I basically try to look at cash on cash return and return on equity, which is sort of like cash on cash return, but in my opinion, cash on cash is really only useful at the time of purchase because if your property value is growing and you're paying down your loan, then the quote unquote amount of money you have invested in a deal is changing over time. Like, for example, if you invest 100 grand and you're making 8 grand a year, that's an 8% cash on cash return. But over time, say that your property goes up and now you have $150,000 of equity in the deal, and maybe you're now making whatever. If your cash flow doesn't go up accordingly, you're making less cash flow. You're making cash flow less efficiently, and so I think the return on equity is a really good metric to follow. I've actually made a couple YouTube videos on how to calculate this. It's quite easy, but it's a good thing for people who are trying to manage their portfolio.
Yeah, maybe we
Um,
can put some
and
of
then
those in the show notes because I think that'd be cool for people to kind of dive in and see how you actually calculate that return on equity.
Right. Yeah. I can show you. It's super easy. And then, I think one of the big things I think a lot of people overlook is they like look at ROI, which to me like doesn't even mean anything. Like ROI is kind of like a useless metric in my opinion,
Okay.
because it doesn't take into time into account. And like any sophisticated investor needs to be factoring in the timing of their returns. If you've heard of the time value of money, it's a very important investing concept. And for that, you do need some more sophisticated metrics like IRR is my personal favorite, internal rate of return, because it factors in cash flow. It factors in how much money you put in the beginning, rehab costs, whether you refi. Like you could, it's kind of like the holy grail of investing metrics because it factors in a lot of sophisticated things, and can give you a time weighted compound annual growth rate. So that sounds really dorky, but that's what it is.
Sexy
It's
to me.
important.
Ooh, time
Yeah,
weighted
exactly.
compound.
It's cool. And actually, I don't know if you know this, but I wrote a book with Jay Scott, if you know him.
Mhm.
He and I wrote a book, and it's like a lot about this, like how you can sort of calculate these more advanced metrics. They sound difficult. They're not. Everyone has Excel. It's not that hard. So just kind of helping you understand these metrics, because I think that's like one of the most overlooked part of investing is people are like, oh, I'm making this money and like I'm going to sell. Like people say like I'm never selling my properties. I'm like, that's not a great investing strategy. Like you should sell and reinvest, or you should cash out, refi and reinvest. But like holding on to that equity and letting your whole net worth build up in one portfolio, that's a mistake I made. If you're asking about mistakes, I did that early in my career, and that's
Me
a
too.
mistake. And sort of you have to like learn these more sophisticated ways of thinking about money, if you're going to manage your portfolio like that. So those are some high level things that I'm personally uh, looking at when I evaluate a deal.
I love that. So, just kind of one note on that then. So, if people wanted to add looking at the cash on equity or return on equity and the IRR, if they want to start adding those into their due diligence process, is the best way to kind of find that, like I said, just go check out your YouTube videos and kind of see how you break it down, and then they can integrate it into their process.
Yeah, well, I'll take the opportunity for the shameless plug because like
Let's
Jay
do it.
Scott and I, if you don't know Jay, he's a extremely smart investor. He's written 4 or 5 books.
He knows a thing or two.
He and I are both sort of like data nerds, math guys, and neither of us like could find a resource where we like people ask me like how do you learn this, and we couldn't find it, so we wrote a book about it. So it's called Real Estate by the Numbers. It's coming out on October 13th by Bigger Pockets. I do have some videos individually about like return on equity. That's one you don't really need a lot of like background understanding. That one you can probably figure out just by watching the YouTube video. I think with like time value of money, you have to like sort of understand the concepts before you just start like plugging things into Excel. And so I'm sure there are other good YouTube videos. I have not made them, but I'm sure if you look at time value of money, net present value, discount cash flow, analysis, those are all like things I know it sounds nerdy, and like if you're doing your first deal, listen, you probably don't need to know this, but if you want to manage like a portfolio over a long period of time, you absolutely need to know this. So whether you buy my book or go look it up on YouTube, I highly recommend you learn this. It literally will change the way you think about money completely, and make you a better investor for it.
Well, that's awesome, man. I'm excited for that book. I'll get on that pre-sale line right now because I'll tell you, for me, being a risk-averse investor, once I understood numbers, it opened the whole world to, oh, I can go pour money into this. And actually, it's better once I learned how to leverage and move my debt around, like you said, instead of just leaving everything in some paid-off property or a super equity-heavy property. It's like it's actually safer to diversify that a little bit, but use these metrics. And the more and more I learn about those, the more secure and safe I feel. So to me, I love it. That's the game changer to me for moving forward. So any piece of that, I'm super excited for. Will you say the name of the book one more time, and how can people
Sure. Yeah.
order it?
Yeah. It's called Real Estate by the Numbers,
Perfect.
and it will help you analyze deals, learn these concepts, and totally agree with what you're saying. By the way, is like I just love that idea. It's like if you're nervous about investing, just learn the math. Like it's it's not that complicated, and you'll just feel so much better because you just be like, oh, I analyzed this deal correctly. I know what I'm doing. And
Yes.
like we said, you never know what's going to happen. There's always variables, but like if you want to invest, you have to take some risk. And if you are able to analyze a deal well, you're reducing that risk to the minimal possible amount. And that's, it sounds like we're both on that, subscribe to that philosophy.
I love it, man. That's great. Well, sweet. So everybody go check out Bigger Pockets to be able to order that. And when it comes out, I'm excited for it. Check out Dave's YouTube videos. Add him on Instagram at the Data Deli. And is that the best way for people to follow you? Is there another way that you
Yeah.
like to keep in touch?
No, that's probably the best way.
Awesome. Well, sweet, man. I guess we've got to wrap this baby up. So here's our end out questions for you, Dave. So investing aside, real estate aside, actual life. There's a life outside of real estate, I heard. What is a
Yeah.
bucket list item that you're excited personally to check off next?
To get married. I'm engaged, and I'm very excited to get married next summer. My fiance and I have been together for almost 9 years now. And so we've held off and tying the knot officially, but I'm very excited to
Hey,
do
you
that.
got past the 7-year itch, so you're good to, a decade is a good time to finally tie it down.
It is good. It is definitely a milestone, something I'm proud of, and I'm excited about
It's
it.
funny. I used to do door-to-door sales, and I remember this old guy. I I asked him like, "What's the best advice you could give me?" And he said, "When it comes to marriage, after about 10 years, you'll know if you got the right one." So you're doing it right, I guess. You figured it out,
All
man.
right. Yeah, I'm glad the old man agrees.
Yeah. So, all right. So, question number 2: what does freedom mean to you personally in your life right now?
I think freedom really just is all about choice, right? Like the ability to choose what you want, and that's not just about money. It's about where you live. I get to choose to live in Amsterdam. It's about like where you spend your time. I get to spend a lot of time with my friends and family. And for better or worse, it is what it is. Money is often the sort of the key to getting those choices. And so I'm fortunate to be in a good financial position, but what I think most people really crave is that choice to spend their life and live their life the way that they want to. And always that's a never ending project, but I'm happy to say that like I do have a good amount of freedom, and I'm very, very grateful for it.
I love that. I think it was Mary Angelou or somebody said that, yeah, her definition of freedom was being able to choose your obligations. And
Hmm,
I kind of, that
that's cool.
reminded me of that. It's like, yeah, there's still things
I
you got to
like
do,
that.
but you get the choice. Yeah. So
Yeah, I
I
like
love
that a
that.
lot.
All right. So last question. Dave is about to blow up everybody's phone on the planet. You're going to send out a text message. We're all going to receive it. What's it going to say?
I think what the message I would want to give to people is to try and add value in whatever you're doing in your life. Try and create value, not just for yourself, but for other people too. I just think there's so much. If you just pursue that, you'll find financial success, but you'll find a lot of other um, satisfaction in your life as well. I think about that's true for investors. Like of course there's like the traditional like add value, like create another bedroom, but like think about the value that you're adding to your tenants. Like take pride in the accommodation that you offer them, or the guest at your short-term rental, or the flip that you're doing. Take pride in what you do. Try and add value to the world. And this, I think the financial and material success comes from that. It's not about chasing money. It's about like trying to be really good at what you do and the things that you care about, and the other stuff comes after.
I love it, man. This has been a treat. Thank you so much for spending some time with us today. This has been great. We look forward to continuing to follow you and your journey and everything that you do. For now, this is Joe Jensen signing off for the Real Estate Investing School podcast, reminding you to just focus and not overthink.